Test 1, 2.
Good morning. Thank you for
joining us for the latest in our continued series of hearings on comprehensive tax reform. Over the last several months, we've discussed the various facets and complexities associated with comprehensive tax reform. A wide array of economists and business leaders have testified before this committee that comprehensive tax reform that lowers rates by broadening the tax base will promote economic growth and job creation. But how much growth and how many jobs is what the American people want to know. Frankly, it's what I want to know, and I think most members of Congress want to know as well. Before we can even determine if a tax reform package is worthy of consideration, let alone be called a success, it's critical to understand the true impact it will have on economic growth, federal revenues, and most importantly, job creation. And that brings us to the focus of the hearing today. Both the capabilities and limitations of the Joint Committee on Taxation in estimating and analyzing comprehensive tax reform plans. JCT serves a critical role in the legislative process by providing expert and impartial analysis of the potential revenue effect of proposals to change U.S. tax policy. However, under current practice, the analytical methods used by JCT do not typically take into account the potential effects of statutory tax changes on economic growth. For most of the proposals analyzed by JCT, this practice is appropriate because the proposed changes would not be large enough to have a material impact on an economy as large as that of the United States. However, comprehensive tax reform by its very nature constitutes a significant change in U.S. tax policy that has the potential to significantly boost economic growth and job creation. JCT has developed a suite of macroeconomic models that can be used to estimate the impact of tax policy changes on economic growth. Today's hearing will help us better understand which policies and decisions are most relevant to promoting economic growth. As our economy continues to struggle, this additional analysis and research will serve an important role in helping this committee make the hard decisions that are necessary to craft comprehensive tax reform. It's my hope that today's discussion will help to highlight how the work being done by the Joint Tax Committee will help us plan and develop solutions that create a tax code that works better for employers and families, instead of one that for far too long has worked against them. I thank the witnesses for being here today, and I yield to Ranking Member Levin for his opening statement.
Thank you, Mr. Chairman. Welcome to all of you. This is a hearing on, and I quote, the economic models available to the Joint Committee on Taxation for analyzing tax reform proposals, end of quote. Let me first say that I hope that neither this hearing nor anything said here today is construed as a criticism of the Joint Committee, its work, or its staff. The dedicated team of economists, lawyers, and other professionals at the Joint Committee produce some of the very best economic analysis in the country, and do so not in an academic or think tank environment, but under the pressures and at the pace of the legislative process. This committee could not function without them, and I thank them, Mr. Bartow, and all your colleagues for your service. The debate over so-called dynamic scoring has been going on for years. During the Bush administration, the Republican majority in leadership, and we remember their statements very well, and Ways and Means members on the then majority side, argued that the Bush tax cuts would pay for themselves and create millions of jobs. Whether guided by this notion of so-called dynamic scoring or by none, the majority ruling this committee never paid for anything. At the end of the Bush administration, we had a $1.5 trillion deficit and an economy that was losing 700,000 jobs a month. There were other factors, but there was nothing dynamic about the fiscal irresponsibility of the then Republican majority. After my reviewing last night today's testimony and grappling with all of its complexities, I urge that we should not become embroiled in a theoretical debate at this particularly challenging time for our nation's economy for two reasons. First, In addition to there being no evidence that tax cuts pay for themselves, quite the contrary. Even most who sound some positive notes about so-called dynamic scoring acknowledge problems that make such an approach unworkable as we confront today's challenges. The reality is that there is simply no consensus in the economics profession about how businesses and individuals will respond to changes in policy, how foresighted they are in their decision-making, or on a host of other questions that would have to be answered to conduct a so-called dynamic analysis of tax legislation. Secondly, and most vitally, there is a crisis before us right now, before the nation, before the committee: economic growth and jobs. The committee, our committee, should be focused on jobs. The 14 million Americans who are looking for work need less theoretical discussion of estimating methodology and more practical action on job creation. One estimate, that of Mark Zandes, is that the President's proposed American Jobs Act would add 2 percentage points to GDP growth next year and 1.9 million jobs, and cut the unemployment rate by a percentage point. Committee Democrats have asked the chairman, you, Mr. Chairman, to hold hearings on the President's American Jobs Act. We have not received an answer, and we renew that request today. The President's proposal would jumpstart our economy and create jobs for American workers. It would put more money in workers' pockets through a temporary payroll tax cut, saving the average family $1,500 a year. It would also keep over 6 million workers from losing their unemployment benefits while they continue searching for work, and provide new employers incentives to help get them hired. These proposals, these jobs and tax proposals, are in the jurisdiction of this proud committee. It is our responsibility to consider them, and I hope this committee will meet that responsibility here and now. Thank you, Mr. Chairman.
Thank you, Mr. Levin. And without objection, any other member who wishes to have an opening statement included in the formal hearing record may submit one in writing. We're fortunate to have a panel of witnesses here this morning with a wealth of experience. Let me briefly introduce them. First, I'd like to welcome Tom Barthold, the Chief of Staff for the Joint Committee on Taxation. We thank you and your staff for your work and your efforts in preparing for today's hearing, and we look forward to your presentation. Second, we'll hear from Doug Holtz-Aiken, who is currently serving as the President of the American Action Forum. Mr. Holtz-Aiken formerly served as the Chief Economist of the President's Council of Economic Advisors and later as Director for the Congressional Budget Office. And third, we'll hear from John Buckley, who is well known to this committee, who is a visiting professor at the Georgetown University Law Center. Mr. Buckley formerly served on the staffs both the Committee on Ways and Means and the Joint Committee on Taxation. And finally, we'll hear from William Beach, the director of the Heritage Foundation's Center for Data Analysis. Mr. Beach has been instrumental in developing the economic modeling capacity at the Heritage Foundation. Thank you all again for being with us today. The committee has received each of your written statements, and they will be made part of the formal hearing record. Mr. Barthold, you will be recognized for 10 minutes in order to adequately explain JCT's current modeling practices. Our other three witnesses will be given the customary 5 minutes to summarize their written testimony. And Mr. Barthold, you're recognized for 10 minutes. Welcome.
Well, thank you very much, Chairman Camp and Mr. Levin. It's always a pleasure to be before this committee. And today I'll be describing for you the economic modeling that the Joint Committee staff uses to estimate the effects of federal revenues from changes in tax policy, as well as provide supplemental economic information for the members' consideration. I think perhaps the place to start is to ask the simple question of what is a revenue estimate, to make it clear. A revenue estimate's an estimate of the change in projected federal baseline receipts that would result from a change in law. Now, the reference point for a revenue estimate prepared by the Joint Committee staff is the Congressional Budget Office's 10-year projection of federal receipts, which is referred to as the receipts baseline. The receipts baseline assumes that present law remains unchanged during the 10-year period and thus asks what receipts will accrue to the federal treasury over the next 10-year period absent any statutory changes. A common misunderstanding that arises when we report revenue estimates to policymakers is that we're sometimes somehow presenting a receipts forecast. Generally, when the economy is growing, the Congressional Budget Office forecasts that baseline receipts are growing. So when the Joint Committee staff reports a revenue estimate with a negative in front of it, that does not mean that the Joint Committee staff is predicting that receipts will fall, but rather that baseline receipts will generally grow more slowly if the proposal is enacted than they are projected to grow under present law in the baseline receipts forecast. Just to emphasize this point, I'd like to refer back to some work we did a number of years ago. Congress passed the Jobs Growth and Tax Relief Reconciliation Act of 2003, known by its clever acronym of JEGTRA, and Figure 1 before you and on the screen, the red bars show CBO's January 2003 forecast of receipts. Now, the Joint Committee staff estimated that the JEGTRA provisions, at least in the first couple of years, would have negative revenue effects. Now, that did not mean that receipts would fall. When we added the negative revenue effects to the CBO receipts, you get the green bars, which is the combination of baseline receipts plus change in growth of those receipts as estimated by the Joint Committee staff. The one thing I want to emphasize is that while lower, the green bars are still growing. So it was not a projection that receipts would fall. They would continue to grow, but at a lower rate. And just to emphasize that point, the blue bars show the actual federal receipts for those years. So actually, in aggregate, our estimates did quite well that year, but the point I would like to make here is that the negative revenue estimate was still consistent with receipts growing to the federal treasury. Now, another frequently expressed misconception about our conventional revenue estimating methodology is the notion that the Joint Committee staff assumes that taxpayers will not change their behavior in any way in response to tax policy changes. It's true that one of the conventions that's followed by the staff is that we hold fixed a forecast of aggregate economic activity. However, within that, the Joint Committee estimates are never static in the sense that our estimates always take into account likely behavioral responses by taxpayers, such as shifts in the timing of transactions, change in the form of income recognition, shifts between taxable and non-taxable income, or more highly taxed to more lightly taxed income, shifts between business sectors in terms of investment and the site of economic activity, changes in consumption behavior, tax planning, and avoidance activities. Now, beyond raising funds for the federal government, members often intend that their proposed tax policy changes alter microeconomic behavior or the future growth prospects of the economy. Our conventional analysis generally addresses only the microeconomic behavior and does not account for possible changes in the underlying Congressional Budget Office macroeconomic assumptions. Now, since 2003 and the implementation of House Rule 13, the Joint Committee staff for any legislation that's been reported by the Ways and Means Committee has prepared a macroeconomic analysis. To undertake this analysis, the Joint Committee staff has used several different models to simulate macroeconomic effects to reflect the sensitivity to different assumptions and to emphasize different aspects of the macroeconomy. The Joint Committee macroeconomic models that we currently use are the Joint Committee Macroeconomic Equilibrium Growth Model, which we cleverly call MEG, an Overlapping Generations model, and a Dynamic Stochastic General Equilibrium Growth Model with infinitely lived agents. I'll highlight briefly MEG and the OLG model just to provide some distinctions in terms of the types of assumptions that underlie these models, and then I'll try and present an example of how we use these models to provide information to the members of Congress. In the MEG model, the availability of labor and capital determines total national output. Prices adjust so that demand equals supply in the long run, but in the short run, resources may be temporarily underemployed, unemployment, or overemployed as people and businesses adjust to outside changes in the economy. Important features of the MEG model is that household consumption is determined by what's referred to in economics as the life cycle theory. Labor supply responses to changes in after-tax wages are separately modeled for 4 different groups of taxpayers that vary by income and type of worker. Household saving and consumption respond to the after-tax return to saving and after-tax income. Business production and the production of housing are modeled in separate sectors, with the business investment responding to changes in what economists refer to as the user cost of capital model. The MEG model is an open economy model. There are cross-border capital flows and changes in net exports which can affect the domestic economic outcomes. And another important feature in the MEG model is individuals are myopic. They do not anticipate changes in the economy or in government policy. By some contrast, the overlapping generations model assumes that prices adjust to any change in economic conditions so that supply always equals demand period by period, and resources are fully utilized after accounting for adjustment costs that may occur as investment changes. There's no explicit modeling of international trade in goods and services, but international capital flows are modeled through interest rate adjustments. Economic decisions are modeled separately for 55 different cohorts. There's separate production sectors for business and housing. Again, there's labor supply responses, saving consumption responses, responses of investment to the user cost of capital model. And the OLG model, unlike the MEG model, is a perfect foresight model. The individuals in the model figure out what's going on. Now, how do we use these models? We take the detailed information that we produce in our conventional revenue estimates about how taxes affect individual taxpayers, individual businesses, investment decisions, and we use those as inputs into the macroeconomic models. To try and give an example, in December of this past year, the Congress passed the Tax Relief, Unemployment Insurance Reauthorization and Job Creation Act of 2010, and Table 1 in your handout and this figure on the board shows you our conventional revenue estimate. It had, by our conventional estimates, substantial revenue losses in the first couple of years, followed by very modest revenue increases. The revenue increases were, again, we're measuring relative to baseline receipts. They're a consequence of substantial timing changes that result from the expensing provisions that were for capital cost recovery that were enacted as part of that legislation. Now, concurrent with our conventional analysis, the Joint Committee staff undertook a macroeconomic analysis of the legislation using the MEG model and allowing varying different assumptions about how the Federal Reserve would respond. Would they aggressively fight future inflation or not? Consumer and business responses to the tax changes in terms of labor supply response and investment response. I'm going to try and briefly talk about these results to give you an idea of the type of information that's added by our macroeconomic analysis. What Figure 2 shows is that the Joint Committee staff estimated, and I believe this is under our what we call our neutral Federal Reserve policy response measure, that the size of the economy as measured by GDP would increase by 0.6 to 1.7% during the extension period, primarily because of the extra demand that would be generated by the tax cuts. The staff also estimated that lower marginal tax rates on labor and income from capital would provide an incentive for temporarily increased supplies of labor and accelerated investment. However, these effects are expected to be reversed by the end of the budget period as the tax decreases expire and increased borrowing by the federal government crowds out some of the private investment, so that in the latter part of the period, you can see on the far right, the negative bars, GDP would decrease by 0.2 to 0.5% relative to present law. The second set of bars that I just flipped up shows an alternative Federal Reserve policy response, and it's important in analyzing macroeconomics to think about what else is going on and how the Fed and monetary policy might affect outcomes. Now, the December legislation was not deficit neutral. To highlight how tax policy changes might have macroeconomic effects, the Joint Committee staff simulated the same policy, but assuming that government transfer payments would be reduced by the amount of reduction in the revenues. We simulated two different time frames for this, either reducing government transfer payments year by year so that we're in balance every year, or reducing the transfer payments in the second half of the period so that we're in balance over the 10-year period. My testimony before you today has the details of that. What I'll highlight here in my closing minute, where I've gone into overtime, is the revenue consequences that one might see from this. Because remember, the key in macroeconomic analysis is if the economy grows, there's a bigger taxable base, and so you might expect that there could be some additional revenue. This first set of charts shows under one set of assumptions just our conventional estimates of the December bill. The second shows what happens when we layer on the macroeconomic effects of that bill. And the third is when we consider that it could have been done in a deficit neutral fashion, and again, depending upon the Fed response. My colleagues and I always strive to update our models with the most recent possible data, look at economic research. For example, we're currently exploring adding a more detailed international trade sector to the OLG model and additional business investment sectors to the MEG model. We always try to provide the members with the best information we can. I appreciate this opportunity to try and give you a very brief walkthrough of some of the work and modeling that we do, and I look forward to answering the committee's questions. Thank you, Mr. Chairman.
Thank you very much, Mr. Barthold. Mr. Holtz-Akin, you're recognized for 5 minutes.
Thank you, Chairman Camp, Ranking Member Levin, and members of the committee for the chance to be here today. You have my written testimony, and I look forward to the questions. I'll be brief in my opening remarks. I think there are three major points to be made. The first is that dynamic scoring is good science, and that's simply the case because the committee should be interested in all of the responses in the economy to changes in tax policy, including the overall level of economic growth, and to exclude that arbitrarily is not good science. So the principle of dynamic scoring really should not be in debate. The second point I'd like to make is that the committee needs to make some decisions in order for dynamic scoring to become operational and to achieve one of the chief objectives of scoring, which is to be able to rank proposals in a consistent fashion. And I think that's where some very tough but not insurmountable decisions would have to be made. In particular, I have considerable sympathy to the difficulties that Tom Barthold and his staff would have in executing this on a regular basis, so the committee would have to include in its process enough time to do this analysis on a regular basis. There's no way around that. Second is the committee would have to decide on a single approach. You've seen three alternative macroeconomic approaches to doing the modeling. In order to get consistent ranking proposals, you're going to have to settle on a single approach so that when you look at two different tax reforms, you can compare them on a consistent fashion. And that would require settling, at least on a year-by-year basis, some of the tough questions about how forward-looking people are and the degree to which you're going to recognize the business cycle responses. I think that's especially important in the debate over tax reform. There is no question that at the moment we would benefit from pro-growth tax reform where we were providing better incentives for the accumulation of human capital, technological skills, and physical capital. But it is also the case that we have woefully underutilized labor and capital resources in the economy right now, and to adopt good policies that both bring us back to full employment and raise the capacity at full employment to grow more rapidly, I think is the objective. You're going to have to get both into the analysis in one way or another, and deciding the rules for doing that is crucial. Third point in this regard is this issue of other policies that are going on in the economy, and you'll have to simply decide two important rules of thumb by which the committee will operate. One would be, what will you assume on a regular basis about the Federal Reserve so that each and every tax reform is accompanied by a comparable Federal Reserve response, and you can get the ranking of them correct. The second, and I think the harder one, will be deciding how you will provide for budgetary offsets when a tax reform loses money or gains money at certain points in time. At the moment, we have two difficulties in this modeling, and I want to emphasize this. The first is actually quite remarkable, and that is that for some of these models, particularly for ones where there's tremendous foresight, those models simply cannot be calculated, meaning the computer algorithms will not run if the federal government's budget is on an unsustainable trajectory. Our federal budget is on an unsustainable trajectory. So in order to actually do the analysis, you have to make some assumption about how to get the debt stabilized relative to GDP. And that's even before you can do the analysis of a tax reform. The second piece is that when you do the tax reform analysis, you have to have a regular and predictable offset for any budgetary gains or losses. Will it be spending cuts? Will it be tax increases out further in the future? The economy will react very differently depending on how you do it. You have to decide upon a set of procedures, which may seem arbitrary, but which will allow you to do the business in a regular fashion. So the short message is that there will be a whole series of things that the committee will have to decide in order to make this operational. They may be better or worse from a predicted point of view, and I want to emphasize what Tom said about the difference between the forecasts and scoring. They may be better or worse from a prediction point of view, but they will allow you to rank things. And then I'll close with simply the reminder that this will not be a panacea. You will not find yourself dramatically changing the federal budgetary outlook over especially the first 5 years on the basis of dynamic scoring. You will, however, probably adopt better tax policies from the perspective of jobs and growth, and I think that should be the focus of the committee's deliberations. Thank you.
Thank you very much, Mr. Holtzake. Mr. Buckley, you're recognized for 5 minutes.
Okay. Thank you, Mr. Chairman, and Mr. Levin, for the opportunity to speak to you today. I will echo Mr. Levin's remarks about the amount of work and the skill that has been brought to this task by the Joint Committee staff. However, they, like every other economist, is faced with the fact that it is virtually impossible to model, for any economic model, to accurately reflect our complex economy with global flows of capital, goods, and services. Therefore, these models, by necessity, use simplifying assumptions, and those simplifying assumptions often bear little relationship to reality. They are also, as both Tom and Doug pointed out, very dependent on assumptions of what other governmental agencies will do, both the Federal Reserve and government and foreign governments, how they would respond to the tax policy. The impacts on important sectors like healthcare, housing, or manufacturing are not modeled, are not measured by these models, or are measured only in very partial ways. Tax reform could easily remove long-standing tax benefits that benefit these important sectors, with consequences that this committee needs to understand. The models do not provide that insight at this time. I would suggest before this committee places a greater importance on these models in macroeconomic analysis, there are important questions for which they should seek answers. The Reagan tax cut in 1981 promised large economic benefits because of its rate reductions. Why did a study by Martin Feldstein on the impact of the 1981 Tax Act conclude that it had no net impact on economic activity? The 1986 Tax Reform Act is very similar in structure to what people are talking about today. Rate reductions coupled with a broadening of the tax base. Under standard economic theory, you would have seen a labor response and a capital response. Yet, a study conducted by the University of Michigan found no measurable impacts on the real-world effects that economists care about. In 2003, opponents of the Clinton tax increases could rightfully say that virtually every economic model in the country projected that that act would reduce economic growth and reduce jobs. The response in the economy was totally different. The economic projections that accompanied the 2001, the 2003, and for that matter, the 2009 tax reductions have not been reflected in the real world. The job growth and economic growth following those acts was far less than what was predicted. I would suggest the committee needs to explore why those projections were wrong before they place greater input on this analysis. I also I agree in many respects with what Doug has said. The question to me is whether you use these models for analysis or scoring. They can provide important insights in designing tax policy, and you can put the assumptions so all tax policies are judged the same. But the real question is whether they will be used for scoring of budget estimates. And that's where I think there is real risk to do damage. These are very uncertain economic projections from even the best of the models. If you base your budget estimates on these models, and those budget estimates do not have credibility in the financial markets, you risk serious adverse consequences. The models have to be both understandable and credible to the financial markets before they can be used in making budget estimates, or I think you risk great harm. They also have to be based on assumptions that the financial markets find credible. And many of the assumptions today do not reflect our economy. Thank you, Mr. Chairman.
Thank you, Mr. Buckley. Mr. Beach, you're recognized for 5 minutes.
Thank you very much, Chairman. Congressman Levin. It is difficult to find economists who would argue that the federal government's tax and spending policies just make absolutely no difference to U.S. economic performance. In this age of massive and growing federal debt, it is even more difficult to find a politically engaged citizen who fails to see the connection between federal fiscal policy and economic performance. Indeed, all across the political spectrum and throughout the leading schools of economic thought, a broad consensus exists that what governments do with tax dollars and with their outlays as well, and how they raise revenues matters in the larger dynamic economic world. Thus, it is crucial that economic models that organize complex theory and data be available and used by policymakers to chart the most beneficial course for the country given the policy options available to us. And I agree very much. Analysis is hugely important. Some observers, however, would warn policymakers away from the use of economic models entirely, even to analyze the likely outcomes of policy change. But the usefulness of the policy tools far outweighs the known disadvantages. Indeed, the absence of dynamic economic analysis in major policy debates should be enough to stop such a debate until it is informed by such analysis. Today's economic policy models carefully sort through the fundamental requirement that behavioral changes be prominent drivers of economic estimates. Likewise, today's complex and nuanced models nevertheless perform with the speed that policymakers require. It is, in fact, unacceptable to deliver estimates of how policy change will likely affect economic activity after the policy change has been adopted. To be frank, there is also the view that dynamic scoring and analysis, and those are two different processes, is a part of the legislative process advanced by advocates only of tax reductions and limited government. This misimpression has done much to keep this useful tool out of the policymakers' hands. Let me illustrate. Heritage used a model of the U.S. economy in 2007 to estimate the economic effects of the tax bill advanced by then Chairman Charles Rangel, Congressman Rangel, who's before us today, when he chaired the Ways and Means Committee. Chairman Rangel's reduction of the corporate income tax rate from 35% to 33%, in fact, drew Heritage's praise. And our model indicated that this rate reduction alone would support the creation of as many as 220,000 jobs. Other provisions of Chairman Rangel's plans, however, we thought neutralized that very good effect. It may surprise some on this committee to learn that Heritage's Center for Data Analysis has published the only dynamic analysis and score of the justly famous tax reform proposal of Senators Ron Wyden and Dan Coates, which previously that bill was co-sponsored, as you know, by Senator Judd Gregg. Our analysis showed policymakers that this bipartisan reform effort could potentially mean that the federal deficit would be $61 billion lower per year, the nation's debt to GDP ratio would be 3.9 percentage points lower in 2020, there'd be 2.3 million more jobs created on average in each of the years in which the tax reform had full effect. No one knows, of course, what policymakers will do, even when they possess the very best analytical tools. This we do know, however. The standard conventional or static tax models used today by the official revenue estimators at the Joint Committee, in the absence of their dynamic analysis, could produce highly inaccurate revenue estimates and estimates of economic effects. It is this record of inaccuracy and thus of bad policy advice that has fueled the interest in dynamic analysis over the past 20 years in which I've been working on this issue. In the real world, we know that businesses and consumers will respond to both tax cuts and tax hikes, and they will do so in fairly predictable fashions. Tax cuts often, but not always, spur investment, which spurs hiring and increases payroll taxes, and they lead to a positive feedback effect for government treasuries. Yet it is exactly this kind of feedback effect that static analysis misses. Advocates of dynamic scoring must be careful not to oversell its capabilities or benefits. There are legitimate disagreements about which economic model best captures the economic effects of tax policy changes. Even so, we get better, more transparent government by encouraging the introduction of more economics into the evaluation of tax policy choices and the occasional use of dynamic scoring models to advise policymakers on really big tax bills. Better government and better tax policy is, I believe, a winning combination of benefits that assures the widespread adoption of dynamic analysis in the process of creating tax policy. Thank you very much.
Thank you. Thank you very much. Thank you all for your testimony. Mr. Holtz-Aiken, the committee's heard from a number of witnesses this year that comprehensive tax reform that broadens the base and lower rates will help spur economic growth and job creation. Can you walk us through the economics of why this is the case and how that might manifest itself in economic models that analyze any proposal? And what is it about that type of reform that would promote growth?
Economies grow in two ways. The first is by increasing their capacity to produce, and that comes from giving up something in the present and investing in either physical capital, factories, equipment, skills and human capital, better and more productive workers, or new technologies and a higher level of innovation. The tax system influences that in deep and fundamental ways because individuals have to give up something now for a return in the future, and taxes affect those returns. And as a result, a tax system that is fundamentally reformed to lower marginal tax rates and take less of that return will incentivize people to undertake those activities. If it's a reform that is durable and predictable, it will also give them greater confidence in those future returns, and by removing that uncertainty, incentivize those activities. So it's really not complicated. It's at the core of the nature of economic growth. It's also true at the moment that the economy can grow by utilizing the existing resources better. We have millions of workers out of work. We have lots of factories not in use. And if we were to undertake a fundamental tax reform right now, we could spur immediate activity on top of these long-run impacts. And I think, for example, a corporate rate cut would right now change the valuation of our existing capital. So we'd see equity values go up. That would make household balance sheets better. They'd spend more. It would change the incentives for business to invest right now and thus lead to the kinds of feedbacks onto hiring and payroll taxes that Bill Beach mentioned. It would also change international location decisions, which happen quickly, right? You could get capital flows into the economy. So in both ways, fundamental tax reform can spur immediate growth and long-run growth.
Thank you. Both for you and Mr. Barthold, as Mr. Holtz-Aiken just said in sort of response to this question, I understand a dynamic analysis would analyze the impact that reform could have on the supply of labor and capital. As he mentioned, idled factories, workers out of work. So given our current economic conditions with high unemployment and large amounts of capital sitting on the sidelines, do you think the benefits of reform could be even larger than historical assumptions? Or, put another way, do the current group of economic models sufficiently recognize the excess capacity that I've just mentioned? And if each of you would like to respond to it, Mr. Barthold, if you'd like to go first.
Well, as Doug noted, macroeconomic growth occurs both from increases in aggregate demand and from increases in aggregate supply. With generally, people tend to think of the aggregate demand effect as more a short-term effect. The point that you were just raising, Mr. Chairman, with the excess capacity means if there were an increase in demand, then we could put resources to work even without expanding the economy's future capacity. In terms of models and what they show, actually our MEG model is an attempt to have what economists would generally think of as disequilibrium outcomes. In other words, our current relatively high unemployment can be reflected in short periods of time in our MEG model, while over the long run you get to more equilibrium outcomes. Is that model perfect? No. Another factor that I think your question also raised is, are we reflective of what sort of outcomes you could see? One thing that I tried to emphasize a little bit was the difference between, and Doug had mentioned this also, the difference in Fed responses. You would expect with current high unemployment that the Fed would be more neutral and would let the aggregate demand aspects, the improved cash flow aspects of a tax reduction, for example, flow through to consumers without trying to fight inflation by raising interest rates gradually. So that would mitigate any longer, some short run and even some of the longer run crowding out effects. So these are facets that the models try to capture perfectly and across all sectors. Obviously, I have to say the answer on that is no, and we're still working on it.
So I think the key for this committee is that if you were to go forward with an approach that encompassed, as the MEG model does, both the sort of near-term business cycle impacts and the longer-term supply-side growth, you could do that in a way that was rigorously comparable both over time and at any point in time across proposals. You would always be starting from a baseline. That baseline at the moment reveals enormous unemployment. We're starting from a very low level of economic activity, and as a result could show quite potentially large business cycle gains. At other points in time, the baseline would have you perhaps right at full employment. The same modeling approach would not give you any business cycle gains because you're already at full employment. It'd only have the supply side approaches. So I don't think there's any disqualifying problem with having that kind of an approach. The baseline would capture the starting point and the degree to which you could get the near-term gains. In the same way, having a consistent rule for how the Fed reacts, I mean, the Fed is unlikely, with large amounts of unemployment, to be raising rates at a rapid rate, and a rule for how the Fed behaves would capture that. So I don't see any overwhelming obstacle to instituting a set of procedures that were consistent at any point in time and captured what's going on in the economy over time.
All right. Thank you. Mr. Levin is recognized.
Mr. Chairman. You know, I want to state clearly why I think this hearing is perplexing and potentially counterproductive. We need analysis. We also have a crisis facing this country and its families, a jobs crisis, a growth crisis. We have proposals presented by the President of the United States relating to economic growth and jobs. Most of those proposals are in the jurisdiction of this committee. We should have an analysis of those. We should have hearings on those. We have one analysis. I don't know if you call it dynamic or, like, I'm in favor of macroeconomic analyses, but let it not misshape what the challenge is before us. So one analysis, as I mentioned in my opening statement, Mark Zandi, is that the President's Jobs Act would add 2 percentage points to GDP growth next year and 1.9 million jobs. And Mr. Holtz, can you say in your testimony that we should not overestimate, that we should have little reason to believe tax cuts, even the best, will pay for themselves, and that over 10 years, no matter what scoring, it's unlikely that there'll be a major impact, whatever model you use. And here we have a jobs crisis, and we need to hold hearings on them. So, look, I remember the fight over the proposal in '93. There were some macro analyses that said, as mentioned here in the testimony, it would lose jobs, et cetera. It would ruin the economy, and it helped lead to a major series of years economic growth and jobs. So that's why it's perplexing. So let me just ask, I'll ask Mr. Buckley if I might, because the chairman asked about tax reform. Look, lowering the rate, widening the base, theoretically has something for it. But you have to discuss what it takes to do that. Correct. You have to discuss that. I took Economics 101 at Columbia. He later won the Nobel Prize for economics. I don't think that helped me very much. I tried. So I want to ask you, Mr. Buckley, if you, as proposed by some as part of widening the base, lowering the rate, you eliminate all of the deduction for mortgage interest, the deduction state and local income tax, you exclude from income the cost of employer-provided health care, you eliminate the charitable deduction, the exclusion of interest paid on state and local bonds. If all those are eliminated, what's the analysis?
You know, Mr. Levin,
macro or micro?
Yeah, however you do it. I do believe that the details of a tax reform matter dramatically. The economists who claim there are large economic efficiency benefits from tax reform are modeling a specific proposal, essentially their vision of what should be an ideal tax system, probably not a vision that this committee would adopt. They cannot analyze tax reform without a specific proposal. This committee cannot either. Some types of tax reform could have a net tax increase on U.S. manufacturing by repealing large benefits for the manufacturing sector.
Yeah, and there's a proposal today to pay for
the rate reduction
by eliminating the remaining money in 136, which I think is mindless.
But I would just say it does not eliminate the remaining money in 136. There's a reduction in the $136.
Well,
it does not eliminate
the remaining money.
It's a big distinction.
No,
it's 1.5. I think there's $7 billion left.
But
in that amount.
But that's all spoken for. That's all spoken for.
Right.
If you look at what is in the hopper now, it eliminates what isn't spoken for. But in manufacturing.
And that's what I think, the one thing the models do not do very well is analyze the impact on sectors. If you repeal current law benefits for owner-occupied housing, I believe you will see a reduction in home prices. I believe that those benefits are capitalized in the value of our current homes. Now, that may be desirable economic policy, but you need to know what impact that would have on the economy, and can you mitigate those effects through transition rules somehow. Until you have those details, and that's really what this debate is lacking, is a detailed proposal, you do not know what the consequences of tax reform will be.
All right, thank you. Mr. Herger is recognized.
Thank you, Chairman Camp. I'd like to ask Mr. Barthold about how the scoring process considers administrative and compliance costs. In 2006, Congress passed a 3% withholding tax on government agencies' payments for goods and services. Joint tax scored this provision as raising federal revenues by $7 billion. Subsequently, however, the Department of Defense released a study finding that for DOD alone, the cost to implement this new tax would be over $17 billion. This means the government would be spending far more to collect this tax than it raises in revenue. Another independent study estimated that the cost to businesses to comply with this withholding requirement could be over $40 billion. In general, the high cost of tax compliance means less money is available for small business to invest in job creation, and many of us are hopeful that simplifying the tax code would reduce this burden and thus spur economic growth. Mr. Barthold, does the current scoring process incorporate the cost to the IRS and other federal agencies to administer specific tax provisions?
Thank you, Mr. Herger. What we're estimating for the committee members are the receipts effect to the IRS. We try to bring into the process at the staff level issues of what it will take for different agencies or different taxpayers to comply, but the estimates themselves do not include direct estimates of compliance costs, except to the effect that compliance and complexity affect taxpayer behavior. If I could make, I know I'm on your time, but if I could make one note about the $7 billion estimate that was done for the 3% withholding at the time that TIPRA was enacted, that actually, I think it's important for the members to recognize that that has two components. Because it's a withholding provision, it has the effect of accelerating tax payments within the fiscal budget period, and that was the bulk of the $7 billion estimate, was an acceleration of payments into the Treasury. There was a second component which was smaller but not insignificant of ongoing compliance gains because, as I know the committee was aware because they had heard testimony, there was some substantial non-compliance by government contractors in terms of paying their legally due income and payroll tax liabilities, and that's what had motivated the enactment of that proposal. I hope that it addresses your question, Mr. Herger.
Well, Mr. Barthold, it would seem to me again where just one department, the Department of Defense, estimated that its costs were going to be more than double what the revenues were supposed to be coming in. It would seem that we're getting an incomplete picture of how tax changes affect a budget. And if tax policy creates new administrative costs for the government, then we have to either increase total appropriations or agencies have to sacrifice other priorities. Conversely, if tax reform reduces administrative costs, that should generate savings in the discretionary budget. Mr. Aiken, from your experience at CBO, do you have any thoughts on this topic?
I am certainly unfamiliar with the specifics of that proposal. I do know that when CBO undertakes to score proposals, it has to make some judgment about the likely implementation, the rulemaking, the time it will take for that rulemaking, and as a result, when the federal budget is affected. And it also has to make some judgment about the overall discretionary funds that will be necessary to implement it. So I think this is part and parcel of doing estimates of the impacts on the federal budget.
Thank you. Thank you, Mr. Chairman.
Thank you. Mr. Johnson's recognized.
Thank you, Mr. Chairman. I am asking that Mr. Bartold, I want to ask you about the revenue impact analysis for the 2003 tax cuts, and in particular the capital gains tax cut. I'm sure you're familiar with the July the 24th Wall Street Journal edition on tax oracles. This is it. Mr. Chairman, I'd like to get this introduced into the record if I could.
Without objection.
Thank you. The editorial points out there was a surge in tax revenue following the 2003 tax cuts. The surge simply was missed by the budget scorekeepers. In particular, with respect to the capital gains tax cut, the Wall Street Journal points out the behavioral models that Mr. Bartold celebrates predicted that the capital gains cuts would cost the government just under $10 billion from 2003 to 2007, when the actual capital gains revenues over 5 years were $221 billion higher than JCT predicted. Mr. Chairman, I think that I would like to ask Mr. Bartold, why was the analysis so wrong with respect to the revenue impact of the capital gains tax cut?
Thank you, Mr. Johnson. I mean, as I pointed out as our staff pointed out in some of the background material that we prepared in our overview, we try to account for taxpayer behavioral responses, capital gains realizations, because it's entirely discretionary, is a very difficult area. As we noted in the document that we published in advance of this hearing with an overview, JCX 4611, we noted in particular that compared to baseline projections of capital gains and a simple static sort of analysis of saying if you change the rate of tax on those gains, what would happen to receipts, that our modeling at the time of 2003 had over 70% of the static effect offset by behavioral change. So we had a substantial behavioral estimate to that particular proposal. Now, the Wall Street Journal's discussion, I think, makes some, without knowing completely what they're always trying to compare, I think they have some confusion in what they take as the baseline projections for capital gains as opposed to overall receipts. In part of their particular editorial and the editorial that they had prior to this editorial, they seem to display some confusion about the point I made earlier regarding whether our estimates are about receipts or change from the baseline of receipts. But that said, as I noted in my testimony, we always strive to try to update and present to the committee as good information and as best estimates as possible. Because of the importance of capital gains in the tax policy debate, it's one area that we're reviewing. We have a research project undergoing right now. In fact, we've just submitted to a small professional conference of academic economists a proposal to present some preliminary results from this research that we would use to change our modeling. So all I can say is, we do our best overall on the.
Well, I recognize it's not a simple thing, but in light of the revenue figures, do you not believe that cutting the capital gains tax rate, as Congress did in 2003, can have a positive macroeconomic impact? In other words, do you not believe that a tax cut, such as the 2003 capital gains tax cut, can lead to greater investment, job growth, and perhaps higher tax revenues?
Well, Mr. Johnson, on that point, you actually enter sort of a different realm about what's the macroeconomic transmission mechanism of particular policy changes. Reducing the tax on capital gains increases after-tax returns to individuals' savings, particularly in that form. The way we would analyze that is that's one component of how people save. Other things, do we shift out of dividend-paying stocks into stocks that accrue more gains? Do we alter portfolios, have less debt, more equity? That all goes into the type of macroeconomic analysis that I tried to present to you briefly this morning. So by increasing the after-tax return to saving, there should be some positive effect on saving.
Thank you, Mr. Chairman.
Mr. Rangel's recognized.
Thank you, Mr. Chairman, and thank you for this enlightening hearing that we're having. I gather from the Joint Committee that the purpose that this panel is here is to share with us the resources that you have available to us as tax writers if and when we move forward with tax reform. And my question to you, does anyone here have any reason to believe that we'll be using this information in order to reform the tax system? I guess not. I guess not.
The answer is yes.
Well, then could you share with me what allows you to believe that this Congress will be reforming the tax system? What have you heard? What indications? Because I've been on this committee longer than anyone else, and I've received no signal that my committee will be moving into tax reform in this session because, as you pointed out, I've been a strong advocate of tax reform. I think it increases revenue, it's fair, it's more equitable. So share it with me, Mr. Beach.
I don't know what the committee will do, obviously. I'm not sitting where you're sitting, and I hope that you do tax reform and do it very soon, and you follow some of the principles that you laid out when you were chairman of this committee. I will tell you that as a longtime person whose group helps members of Congress shape their bills and does some analysis of their bills to help them understand better, I'm getting a lot of business. And I think as a market indication, there is a strong interest among members of this committee and members outside of this committee in reforming the taxes. But I think also a lot of members understand that there is a dance that has to be held here. And one partner is tax reform and the other partner is overall fiscal reform. And it's the difficulty of finding how you, in fact, dance with those two partners.
But what you're saying, Mr. Beach, is that it's a complex and sensitive subject politically, and I don't see how you think that we can overcome that problem this year, and I know you're not talking about having this committee move into a tax reform mode next year. I guess my real question to you, based on your experience, when the president has a tax proposal of any kind, as he recently reported, you don't believe that you can really be for or against it until the Committee of Jurisdiction reviews it and has hearings on it. Would you agree with that statement?
That's a matter for the committee to take up. I know there's tremendous interest in this outside.
You're paying taxes, and you're going to be affected by what happens here. Now, you got a 12-member committee. You know what the Ways and Means and the Finance Committee's responsibility is. You know about deadlines that we have. Yep. I hope you're not suggesting that you think that we can do tax reform between now within the deadlines that the Congress has. Is that what you're telling me?
You shouldn't do it. If you're not started right now, you should take your time to do tax reform, but I don't mean to take all the time in the world.
That means that you agree with me. You don't think it's the right thing to do to start tax reform now with all of the congressional restrictions that we have on timetable.
You have already started tax reform. There are so many discussions going on, but this committee and the Congress has a duty which is even greater than that, and that is to plot a course through the most difficult financial challenge that this country has faced, perhaps in the last 100 years, and tax reform is part of that, but also major changes to our spending priorities is part of that as well.
Thank you, Mr. Chairman. I assume that means that you don't expect us to do tax reform this session.
All right. Mr. Teaberry is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Barhold, I want to follow up on the line of questioning from Mr. Levin regarding the President's Jobs Act and how you model that Jobs Act. Let me give you a real-life example and tell me how your process applies to this. I had a discussion Monday with a constituent who is part of a family-owned business. They are an S Corp. And he and his wife were looking at making an investment decision, and they were down the road of making this decision. The President's proposal has an impact on that investment decision, and thus he and his wife now have put a hold on that investment decision, an investment decision that theoretically would create jobs and opportunities. And so based upon the President's proposal, that has stopped. And it's going to stop for maybe forever, based upon the President's proposal and what happens to it. How do you and your folks at Joint Tax figure that out and apply it to real life?
Mr. Teaberry, I mean, you raised a really important issue in economic modeling, and that's how to account for individuals' or businesses' expectations. You know, as you've described your constituents, they apparently feel pretty strongly about the uncertainty that's created by introduced legislation. We try to account for, as I noted, you know, taxpayer behavior in all the estimates that we do. What is particularly difficult, I think, in what you proposed is if the what's that do to the baseline? We make these estimates relative to baseline receipts, and the baseline receipts projections aren't assuming that there's any change in law. So our baseline receipts projections assume that a lot of investments, you know, would have gone on as projected under the macroeconomic projections of the Congressional Budget Office. The situation you've posed is you think that legislative uncertainty may change, you know, the course or timing of those investments. Now, when that gets picked up is when the Congressional Budget Office redoes its macroeconomic forecast. If they redo the macroeconomic forecast, that'll then be reflected in what we think about the course of the economy, the course of receipts, you know, from business income. But as you posited this particular situation, that's sort of missed in the economic modeling right now, because you said your constituents had something they were thinking of doing, let's say in the next 6 months, and now they're not because of legislative uncertainty. We've recently had a revision in the CBO macro forecast. We're not picking up in anything that we're doing on Capitol Hill in our modeling really that reflects that kind of uncertainty and change decision because of current legislative uncertainty.
And since CBO was mentioned, Mr. Holtze, can you comment from your perspective when you sat at CBO?
I would concur that the incorporating explicitly policy uncertainty is one of the real weak points of the current state of economic science. And you know, in that regard, if I could, I think it's important to distinguish between scoring and forecasting. And you know, think about football. For reasons that I don't know, if you get a touchdown, you get 6 points. If you kick the extra point, you get 1. If you run or throw it across, you get 2. I have no idea why. But those scoring rules allow you to compare two teams. They allow you to compare games across the country and over time. And that's what you want out of good rules to evaluate legislation. You want to be able to score them consistently. You'd also like to be right, but the committee operates in areas where, quite frankly, often it's impossible to be sure you're right. We passed the Medicare Modernization Act when I was at CBO. There had never before been a product which was insurance for the costs of outpatient prescription drugs offered by the federal government. We developed scoring rules so that there were more and less expensive ones. We had no idea if we were right. Turned out we were way too high, probably 30–40% too high. And over time now, I think scores of prescription drug estimates will get better. I think the same will be true for the Joint Committee. If you go down this route, you will bring into the scoring additional information, growth consequences, And they won't be right the first time, but they will get better and better, and at every point in time, you'll be playing fair across proposals. That's the key.
And some,
Thank you.
my
Thank you.
time has expired. Thank you, Mr. Chairman.
Mr. Davis is recognized.
Thank you, Mr. Chairman. I'd like to continue that in that line of questioning, Mr. Eakin. In your testimony, you suggested coming up with a new single approach to estimating that provides uniformity in scoring while taking aspects of both static and dynamic scoring into account. How does the current regime produce scoring estimates that result in qualitative difference, in your opinion? And following on that, how do you think a new system would treat comparatively a reduction in marginal rates, versus, say, the credit from state and local sales taxes? And I'm not looking so much for a specific answer on the second, but trying to get down to a more realistic aspect of estimating.
I think that it's important, if you're worried about economic growth, particularly over the long terms, longer horizons, you want to have a system that reflects the fact that there's a big difference between a revenue-neutral tax reform that cuts marginal rates, broadens the base, and one that might say jack rates up on every taxpayer in America and then provide a refundable credit to exactly the same people. It'd be revenue-neutral. Some people might take that cash and spend it. It might look like a good idea in the near term, but over the long term, those are terrible incentives for labor and capital and growth. And you want the process to reflect those incentives. And static models will not capture those longer-term impacts.
Anybody else like to comment on that? Mr. Buckley?
Yeah, the only thing I would say is there's a sharp difference, I think, between analysis and scoring. And that's where I think a lot of these models may be useful in analyzing different proposals and the comparative benefits. And when you're doing that, the committee can specify assumptions that they want the Joint Committee to follow. I don't think you can do that for the actual scoring of the legislation. And that's, I think, the real question here is analysis is very good. Do exactly what Doug has suggested, put the assumptions in there, and you can compare different proposals across the board. But if you use that for determining the budget score, what you reflect as the budget cost of the bill, the perception of political interference, if this committee sets the assumptions, and somebody has to do that, those estimates then have no credibility. And I think you run a real risk in the financial markets if you use that type of estimate in determining the ultimate cost of the bill. So I think the real question here for the committee is analysis is fine and good. You want more information, but you should be very careful before you take that final step and say that the actual official score of the legislation is determined with regard to these models and with regard to the assumptions that the committee specifies.
Great, thank you. Mr. Eakin, you wanted to add an additional point?
I think this is the right discussion. I think I come down in a different place. Point number one is that I see no qualitative difference between the kinds of uncertainty that surround these growth effects and the different models that capture them, and the kinds of uncertainty that surround the conventional micro uncertainty around a lot of scores. We did scores for terrorism risk insurance. I hope we never find out how accurate they are. There are fundamental questions of uncertainty that pervade the scoring process. There's nothing new about that here. I also would come down in a different place with the financial markets. They use these models every day in order to evaluate exactly what you're doing. So I don't think they're going to be at all fazed by the fact that you use them to make your decisions better. They're using them right now. And the third thing I'd say is that there will be some arbitrary decisions, and the goal to make them appear to be done in an even-handed, non-political fashion is an important one. Transparency would do a lot to solve that. And so I think there is a route forward.
Okay, thank you. Mr. Beach?
If I could just, there's one thing I would want to remind the committee is that when they take a score of an important bill from the good people at the Joint Committee on Taxation that is not built on an economic model, be under no misimpression, you have used an economic model to get to that score. What you're assuming is the economy does not have an effect. So anyway, shape or form, when your scores come in, there's an economic set of assumptions behind that. What we're saying on this panel, I think we're all agreed, is that you need to have the best information, the best advice possible to plot that good course to a better economy, and that's why dynamic analysis is so crucial, and it should be part of the routine pieces of information that come to this committee. But when you get a static score, the assumption is the economy is not working there. There may be microeconomic behavioral assumptions built in, but the general economy is not responding. That's the assumption made by the static score.
Great. Thank you, Mr. Chairman. I yield back.
Thank you. Mr. McDermott's recognized.
Thank you, Mr. Chairman. Mr. Chairman, I've spent 40 years sitting in Ways and Means Committees, 17 years in the state legislature and 23 years here. And these mind-numbing discussions always remind me of Henry Jackson, our senator, who once said that what he was looking for was a one-armed economist. So he wouldn't hear any more of this, on the one hand this and on the other hand that. And what, in the state of Washington, I hired a guy in 1979 after we lost our bond rating and whatnot to do our revenue estimates, because we always had a fight between the governor's office and the legislature as to what the revenue was going to be. And we finally said, let's get one guy, and he would give us a high, a medium, and a low, and then we'd pick one, and the governor had to live with it, and we had to live with it. Now, up here, we keep playing this game of OMB and CBO and the Joint Committee on Tax and everybody else, and it's all for political reasons. Groucho Marx probably said it best when he said, when you go into politics, the first thing you have to learn to do is to have a straight face. And we sit here and have these sober-faced discussions, but we know that we're never going to get a balanced budget, because one group is going to say, if we do this, if we cut taxes, the revenue will go up. And another group will say, no, if you cut taxes, the revenue will go down. And we never agree on the baseline, and we fight. And all of what we do, we're going to have come to a showdown here on the weekend, because people say we're in so much debt that we can't. What can we do? Well, it depends, but we don't have one definition of being in debt, because we don't talk about the investment in infrastructure. We don't talk about a lot of things when in some kind of unified system. And my belief is that these discussions, the majority will decide what they think the estimate is. I think this hearing is probably about, let's use some dynamic scoring so we can make things look better in going into some kind of a tax reform discussion. And I listened to, or I read, Mr. Buckley, your statement that if we accept some of these assumptions, we may have a negative effect on the market. Could you expand on that? I mean, we're sitting here today with the Republican leadership saying that we don't want Bernanke fiddling with the interest rates, because it's going to, I don't know what, they don't want things to get better. That's pretty clear.
Let me stay and slightly respond to what Doug said. Businesses do use macroeconomic models in making business decisions, and that's exactly what I think this committee should do. That's perfectly appropriate. But when they report to their shareholders, they record the cost without reduction for the potential gains that may result from the investment. If any business reflected in its current statements the prospective but uncertain benefits from its current benefits, it would probably violate every securities law. So to say that business use these assumptions, that is correct, they do, in making business decisions. They do not use these assumptions when they report to shareholders. If the profits from the investment actually are realized, the business takes those profits into account in the year in which they're realized. What they're asking, if you score using these estimates, you are asking, you're saying that the federal government will take into account uncertain benefits before they're realized, and I think that's pretty dangerous. I think it is dangerous as far as the acceptance of the market for cost assumptions going forward.
What difference would it make to the market if we started taking those potential investments?
If the markets suggested that you could pass big tax reductions and pretend that they are not, have no cost because of uncertain projections of future macroeconomic benefits, they would not respect those decisions. I mean, there is a point where you need credibility in your budget assumptions. Those budget assumptions have credibility now because they are consistent with the cost accounting standards that businesses have to follow in their everyday life.
Can we have that as long as we have OMB and CBO fighting over?
But they're not making assumptions about the wisdom of the change in law. They're making microeconomic decisions about the effect on revenues.
Time has expired. Mr. Buchanan's recognized for 5 minutes.
Thank you, Mr. Chairman, for holding this important hearing. I also want to thank all our witnesses today. Mr. Eaton, I was curious. I want to get taxes. I want to talk about taxes and small business in a minute, but I was very interested to read your comment the other day on the Federal Reserve. I believe we need to audit the Fed, and I've talked to a lot of people in Florida who are concerned about the Fed and their active involvement. What's your thoughts on whether the Fed should be more active or less active in terms of our policies?
I have no idea what I said. I talked too much, evidently. But,
okay. Well, I heard your comments. I think it was along the line that the Fed was too active, and I just hear that comment.
I don't think there's. I mean, there are multiple discussions about the Fed right now. Number one, I do not believe that there is much the Fed can do to enhance near-term economic growth at this point in time, and that doing nothing is essentially the right near-term decision, in my view. They still have capacity to help us if, God forbid, European financial shocks or something get transmitted in the U.S. They can step in and help us on the downside. And I believe that I'd prefer to, have the Congress of the United States do appropriate oversight in hearing settings and make sure that the books are squaring things. But I do not want the Congress of the United States running U.S. monetary policy. I've seen how the Congress has produced fiscal policy, and I'm not overwhelmed.
Yeah. Let me just, the other thing I wanted to get on is the small business. I know we all believe is the backbone of our economy, creates 70% of the jobs. And I see it in our communities are concerned about taxes and where that's going. There are also the lack of credits out there. But Mr. Barthold, in terms of your modeling, what have you taken into account in terms of pass-through entities? I mean, how do you look at that in terms of your modeling?
Well, pass-through entities are part of our conventional modeling, and then to the extent that the conventional modeling feeds into the macroeconomic analysis that we provide from time to time, it's there. On the macro side, as I noted in the testimony and the overview document, we don't divide the business sector into small businesses, medium businesses, large businesses. It's actually a much more crude aggregation. Most of the time we're looking just at business investment and investment in housing. But on our conventional modeling, as I know you know from some material that we went through earlier in the year, we have a substantial amount of background data on the types and numbers and distribution of different entities, sole proprietorships, S corporations, partnerships by industry, and we use that data to analyze all the different proposals that members such as yourself bring to us. And so,
yeah, let me, a lot of gets thrown around, and I've been in business for myself for 30 years and been active with a lot of small businesses, and I'm concerned because a lot of times it gets thrown around about the idea only 2% of small businesses are affected by, the tax increases, but yet when you look at the income of these pass-through entities, 50% of the income is impacted. And when you look at the environment, especially in Florida, but I'm sure other states where you have a lack of credit, the growth and whatever success I had because I had strong banks that were able to back in cheap capital. But when you take into account a lot of pass-through entities looking, their taxes are going to go up along with a lack of capital. Then we try to figure out why we don't have the job creation. That's what I'm getting feedback on every day back in Florida. Do you have any thoughts about that?
I think the issue that you're raising is very similar to the issue that Mr. Tiberi raised earlier, and that's to what extent does current legislative uncertainty affect current business decisions, and then how is that reflected in the modeling? And I noted that, you know, sort of short-term uncertainty that's not picked up in the periodic updates of baseline projections of investment, macroeconomic activity, you know, business income is missed in the process.
Mr. Beach, do you have anything you want to add to that?
Pardon me. It's very important to do the pass-through entities correctly, and in models that we use, we take a lot of time to take a look at which ones are most likely to be benefited by drops in capital costs because of the capital-intensive nature of some of those pass-throughs, labor costs because of that, and so forth. And you need to have very detailed information. Fortunately, I can tell you that the Joint Committee does a pretty good job of sorting through that. I will also tell you that I think the Joint Committee would benefit tremendously by having more active participation of advisory panels, outside groups that would come in and not oversee their work, but be a place where they could try out new ideas and get suggestions. And there's a lot of people in this town and around the country that are handling questions just like you've asked that are outside the Joint Committee.
Time has expired.
It needs to be more of an advisory.
Thank you, Mr. Beach. I yield
Thank
back.
you. Mr. Smith is recognized.
Thank you, Mr. Chairman, and thank you to the experts on the panel here today. I certainly want to be sensitive to the fact that there are a lot of moving parts in the economy, and I think I hear you saying that it's hard to predict everything, and I'm certainly sensitive to that. You know, we're forced to, and I think it's healthy, to look even beyond the 10-year window. Mr. Holtz-Eakin, do you think that we could use dynamic analysis perhaps to even look beyond the 10-year window?
I think it would be incredibly desirable to do that. I mean, you certainly want to always use all the information you can about the long-run consequences of both the tax and the spending policies of the government. There's no question. We have enormous long-run problems that the 10-year budget window doesn't capture right now. The only real issue is the degree to which you bring those into the formal scoring process, and that's the place where the Holtz-Eakin-Buckley feud shall continue. I mean, can I respond to what he said? I mean, I really think what he has said is wrong. I know this is your time. We'll do it quickly.
Please.
Under current procedures, the CBO and the OMB would put out a baseline budget projection in January, and those would be budget projections for the U.S. This committee could then, in the middle of the year, pass a tax reform under current procedures, and when the next January came around, CBO and OMB would have to create new budget projections, and they'd have to look at the new current law, and they'd have to decide whether that tax reform helped growth or didn't. All we're talking about is whether during the year you actually use that information to decide among tax reforms. It's not going to change the integrity of the budget projections. The financial markets are not even going to notice.
Okay, thank you.
If I would have an opportunity.
Please.
You know, I think...
Quickly.
I'm sorry, on your time, too. It really is, you're right, you keep doing changes in estimates. There is no way that the CBO estimate next year is going to be dramatically different by reason of a tax reform enacted this year. I don't think it's going to change the projections all that much. The real question is how you score it. And if you score it in a way that hides the budget costs, I think you run into trouble. And particularly if you score it under assumptions that this committee selects, and that's what Doug says you have to do, then I think you have real problems. I think it's different if CBO has a new baseline. I think it is a quite different thing from this committee saying we shall assume that the Federal Reserve is going to accommodate this in this way. We shall assume this and we shall assume that. And therefore, you determine the score, you determine the score by the actions of this committee. That is a political judgment that I think you're perfectly appropriate to make, but I don't think it should affect the budget score.
Okay, thank you. And pardon me while I shift gears a little bit, but I know that tax policy does have consequences in the economy, and I know that different states have different tax policies among themselves. And so I've seen where tax policy affects behavior. I think that's, we can all agree on that to a certain point, and that take, for example, Section 1031 exchange policies that oftentimes encourage some behavior that impact market values, and then a high property tax state like Nebraska sets property taxes according to market value, and all of a sudden, federal tax policy can effectively influence and affect a local tax policy, even the most local of taxes being property tax. And is that taken into account in an analysis of any form right now? Mr. Barthold?
Yes, Mr. Smith. There's a couple different avenues in which some of the state and local effects are. Now, what we don't do is we do not project that there will be a change in the budgetary receipts in the state of Nebraska or in the state of Missouri. But we do, as part of our individual modeling, for example, we have to the individuals in the model, we have them assigned to states. We have upgraded from time to time. In fact, just this last year, a state tax calculator, so that when we look at behavioral effects, we take into account the combined marginal tax rates at the federal and state level. We also use that state tax calculator to look at possible itemized deductions for real estate property taxes and state and local income and or sales taxes. So we do try to account for some of the interaction that is in the federal system, but it doesn't go down to projecting budgetary outcomes for specific states.
And then how that might come back around and affect federal tax receipts.
Unfortunately,
very much.
time has expired.
That's how we got there.
Mr. Neal's recognized for 5 minutes.
Mr. Chairman, thanks for holding this hearing, and I often think that this is a part of congressional life that the public does not get to see, where there really is an exchange and you listen to people who do this every day, and there's good give and take, and the people that are at the witness table are not only seasoned, but just as importantly, I think, pretty honest about the arithmetic that's put in front of them. I appreciate it very much. I've tortured Mr. Holtaken over the years with this question. I see no reason not that I should leave him alone today on that basis, and he knows where I'm going with this. He already knows the answer, and I know the answer to the question that I'm going to raise with him. But I appreciated his candor. I was driving along one night listening to a lengthy NPR piece, and Mr. Holtaken was the subject of the interview. And I thought that the candor that he expressed on the campaign trail was very helpful to the dialogue as well. But do you think tax cuts pay for themselves?
On average, no.
Thank you. Now, I'm going to come back to you for a second here, because I also want to question Mr. Buckley for a moment here. You were around during the Tax Reform Act of '86. And how do you realistically think that we can get to that 25% rate that is being shopped by many in this town at the moment? And I'm going to give Mr. Holtaken a chance to speak to that as well.
Unless you're willing to sustain a large net tax reduction, and that's clearly a question here, I doubt that you can get to 25%. If you follow your normal practice of providing transition relief for people who have made investment decisions based on the current law. For example, you can raise a lot of money by repealing the mortgage interest deduction. However, if you decide it is unfair to repeal that deduction for people with existing mortgages, the amount of money you raise disappears rapidly. A lot of the numbers that are being used for tax reform debates so far are not revenue estimates. They are static tax expenditure estimates. I mean, if we're talking about purely static, tax expenditure estimates are static. So a lot of the estimates that people are using are static estimates. It will be estimated with behavioral responses, not macroeconomic responses, but behavioral responses. So I think it's very difficult to do without being pretty rough and not properly taking into account the investment decisions that people have made based on current law.
Mr. Holtaken?
I think qualitatively the key is that the tax code now subsidizes to a tremendous extent consumption items. Mortgage interest deduction is the consumption of debt-financed owner-occupied housing. Employer-sponsored insurance exclusion is the subsidization of the consumption of insurance and the health products that it pays for. If you go through the list, by and large, what we do with the tax code are things that subsidize what is the opposite to growth policy. It is consume now, forget about the future. So if you want to get rates down and you're serious about growth effects, you have to reform the tax code to reward saving and investment and to stop subsidizing consumption. And that's the only way you will get rates down. That points to the reason why it is very often the case that tax cuts don't pay for themselves and that analyses of tax policy don't show big growth effects, is because often it's not very good growth policy. There's a lot of tax policy that simply is not.
Thank you. Mr. Bartholold, he just teed up the question that I want to raise with you. Mr. Beach disagrees with the economic models you use as it relates to static estimates. Would you like to expound upon the testimony you offered based upon the models that you've offered today?
Well, I just wanted to take issue with the word static. As I noted in my testimony and we noted in our background material, and came up in the discussion of capital gains tax policy changes. We incorporate at the microeconomic level a substantial amount of behavioral response. We try to account for compliance behavior, portfolio changes, shifts between investment sectors, all in response to tax proposals that the members offer to us for economic analysis. And what we've pointed out some today is that in macroeconomic work that we've tried to do for the committee, we're presenting further economic analysis on how some things that have broad effect, might have broad effects on the economy in terms of labor supply and capital investment, how they could matter to future economic growth.
All right, thank you. Mr. Schock is recognized.
Thank you, Mr. Chairman. First, I'd like your permission to submit questions in writing to these panelists so that they can respond in writing if I run out of time.
Without objection.
First, Mr. Holtz-Aiken, your response to tax cuts don't pay for themselves. I'm curious, by my friends on the other side who keep pointing this out, I'm wondering whether or not government spending to spur economic growth pays for itself.
Not in my view, no.
And so when you said earlier that oftentimes cutting taxes is not an effective way at spurring economic growth, obviously we've tried to spend a lot of money here in Washington, D.C. to spur economic growth. Which of those two paths do you think is a better one to spur economic growth, if you can? And if not one of those two paths is better, is there a third that we're not seeing?
So I think if you look at long-run growth, ignoring business cycles, unquestionably the preferred packages, pro-growth tax reform has the bigger impact. I have little doubt about that. The debate over what happens in the short run, throw money at the economy, get Keynesian effects, cut taxes, get Keynesian effects, I think both have proven to be relatively inefficient and not something that we ought to get too high hopes for. And I guess the biggest thing is, have a discussion where how you cut taxes matters, not just do you cut taxes, and how you spend money matters, not just do you spend money. There's a big difference between providing high-quality infrastructure over the long term and passing out cash benefits to American citizens.
Do you think that infrastructure spending matters if it's more long-term and sustained? For example, a highway bill over 6 years versus a 1 or 2 year stimulus bill?
I have little faith in so-called infrastructure stimulus spending. This for decades has been a phantom that Congresses have chased. It never arrives in time. It's often spent on bad projects. It is not good policy. There is no question that we need better infrastructure programs where we spend the money wisely, and I recommend to you a private sector commission report that I can get to you on reforming transportation infrastructure programs.
I would like that. Thank you. Mr. Barthold, we had a panel of company CEOs and CFOs before us on the issue of tax reform, and I specifically asked them. Many of them receive different types of credits, deductions in our current tax code, whether or not, in fact, eliminating all those tax deductions and going to a straight, for example, 25% rate would be better for them. They unequivocally, all of them said yes. I then asked them whether or not, in fact, their business models would stay static or whether or not they would, in fact, invest more money in the United States. Most of these were multinational companies. And again, went down the line, Republican and Democrat witnesses alike all uniformly said they would, in fact, invest more in the United States if we got rid of deductions and could get the rate close to 25%. That leads me to ask you specifically a question. And I'll put it in writing so you can respond in writing, but maybe you can take a jab at it with the time that you've got. First, whether the Joint Committee revenue estimating methodology would assume one or more of the following. First, that U.S. multinationals would increase the amount of their U.S. domestic investing by investing capital inside the U.S. that under current law would have been invested outside the U.S. Second, that the amount of foreign investment inside the U.S. would increase above what is expected under current law. Third, that less earnings strippings would occur with respect to foreign investment in the U.S. than occurs under current law. And fourth, would U.S. companies engage in less income shifting than occurs under current law?
Okay. Well, I think I can take at least a short answer on that, and I'll be happy to give you a more detailed response in writing. You asked really about both sides of U.S. domestic investment in response to a lower corporate rate. First of all, we think, and it of course depends upon what other tax policy changes are made, but if we're just saying lower corporate rate, that gives incentives for corporations to expand their business activities in the United States. So yes, we would, part of our modeling would show, particularly if we're talking about macroeconomic effects, but we would show that U.S. investment by U.S.-based multinationals should increase. Similarly, it does make any investment by anyone in the United States more attractive. So we should expect also that the incentives would be for foreign-based multinational corporations also to expand their business activities in the United States. You asked about two aspects of income shifting. For inbound investment by foreign persons, there's some evidence, it's mixed, of what's called earnings stripping. That's because of the ability to deduct at a relatively high statutory tax rate against the U.S. base and report that income abroad. With a lower statutory tax rate, again, the incentive would be less earnings stripping. And on the flip side, outbound investment or activities to try to locate U.S. multinational income abroad rather than the United States, the incentive would also be to retain more of that income in the United States.
Thank you. Mr. Becerra is recognized.
Thank you, Mr. Chairman. Gentlemen, thank you very much for your testimony. Mr. Bartold, from what I can gather, trying to work through all the economic speak, this is like trying to ride a bucking bronco when you're trying to come up with a good score. In the modeling that's done, and that's been traditionally done, have you all developed a sense of the variables that you can include in this equation to give you your score that you have the most confidence in helping you come out with a result that reflects reality?
Mr. Becerra, interesting question that you raise. It's really about the level of uncertainty that there would be to different aspects of our modeling, different aspects that in proposals that members might create for us to think about. As Doug had mentioned before, there are some areas that are well known and well trod and relatively well understood. There are other areas also where there's lots of good data and the outcomes seem quite clear. And then there are some where we're really very much in the realm of the brand new and the unknown. As an example of something that's well known, well understood, good data, You know, one policy that has been changed from time to time by this committee has been to adjust the value of the standard deduction and the personal exemption. We feel really, really good about our estimates on that. One, because there's not huge behavioral responses from those sorts of changes. The numbers are quite clear, and it's well understood area. Lots of good data.
So you have a higher degree of confidence with some of the variables that you have in this equation than others.
That's definitely the case, Mr. Chairman.
And I assume that as we move forward, the more data you collect, the greater your ability to know if you can feel confident about tweaking a particular variable or adding or subtracting a variable.
That's so. I'll just leave it as that's so.
Yeah, and I mean, to the degree that economics is a science, and to the degree that your modeling and CBO's modeling to come out with a score, an assessment, can be characterized as a science, we're essentially making some very educated guesses about what we think this very fluid and dynamic economy will do if we tweak it here or there based on a policy change in law.
To the extent that estimates are guesses, what you say is correct. I mean, our models are empirically based models, so where there's better data, where there's been more testing of the data, more similar sorts of policy changes in the past, we have better confidence about the estimates that we make from those models than when we're starting with something brand new, and where there's limited data.
So let's put aside for a moment this unresolved question of whether tax changes can produce measurable macroeconomic effects. Mr. Buckley, let me ask you a question. Is there a constant relationship between GDP growth and jobs?
You probably are asking the wrong person on the panel. My guess is there is. That the greater economic growth, the greater job growth. I mean, I would, since labor is such a large part of our economy, I would guess that yes, there is.
So, and Tom, I know you're, I apologize, Tom, maybe that should have been directed first to you, and then let me go back to Mr. Buckley, because I wanted to ask Mr. Buckley a question. But to the degree that you think there's an answer, is there a constant relationship between GDP growth and jobs?
There's a positive relationship, if you mean constant, if I could say, for every $50,000 increase in GDP, that represents a half of a job or one job. There's going to be variability because it depends upon what sector's growing and what sector's producing the GDP. But as a general matter, real economic growth means greater job opportunities, and in particular, it means greater income for individuals.
And different economic growth policies could have different job consequences.
That's certainly the case.
Okay. And so, Mr. Buckley, looking at it from the other end, would a budget score in and of itself tell policymakers about the loss of jobs?
I'm afraid time has expired, Mr. Buckley. If you want to respond in writing, that would be fine. Ms. Jenkins is recognized.
Thank you, Mr. Chairman, and thank you all for being here. I would like to follow up where Congressman Schock left off on the international front, maybe for each of you to comment, because we all know the U.S. economy is a whole lot more global today. Many experts tell us that our tax code hasn't kept pace with the globalization, and one option would be to move American companies toward a more territorial style tax system. So a couple questions. If we would make that change, are the models available, capable of accurately estimating the impact of this change on economic growth and investment decisions? And if not, do they need to be updated to estimate the impact on the economy of bringing our international rules more in line with that of the rest of the world?
Well, thank you, Ms. Jenkins. Within our conventional estimates, I had noted in my testimony that we use a fixed GNP as opposed to GDP as the baseline assumption, GNP being the measure of income which can be earned by U.S. people either abroad or in the United States. So within our conventional estimates, we model some cross-border investment flows of U.S. taxpayers. Now, what we don't do with in the conventional estimates is then incorporate possible effects from those flows on domestic productivity and ultimately domestic employment and sort of second-round macroeconomic income growth. And I pointed out in my testimony that our MEG model actually does incorporate cross-border flows from foreign and U.S. investors, and that as investment flows, that has effects on productivity, ultimately increased employment, increased outcome. The MEG model assumes that domestic and foreign investment responds to after-tax returns. So in assessing a proposal that might involve territorial concepts, more territorial concepts as opposed to worldwide concepts, that would be part of how we would analyze that for macroeconomic purposes. Some things that are not in our modeling, one feature that will be important ultimately is if the United States does something, what does the rest of the world do? And we do not model what the rest of the world does. That's a hard one to guess in any event. And I should note that while we do, one of the work projects that I noted is we were trying to upgrade our overlapping generations model, which gives some alternative sensitivity for members. We're trying to upgrade that to more explicitly model cross-border flows. Right now, the cross-border feature is only reflected in sort of net interest rate changes.
Okay, thank you. Any thoughts, comments?
I would defer to Mr. Beach, who actually has a model, and ask how he does it.
Okay.
Yes, Congresswoman, thanks for that question. I would refer you and the members of the committee to the analysis that we did of the Wyden-Gregg-Coates bill, where a much lower corporate rate was introduced down to 25%. We had territoriality. We had major economic effects coming from the rest of the world, and you can look at that, and I'm very impressed. I was part of the team that helped build the MEG model. The MEG model has great capabilities for doing these things, and that research program you just heard of was very good. With respect to how we handle the rest of the world, when our tax rate goes down, as you well know, the rest of the world tries to follow, and we use Ray Fair's model out of Yale University, which is available at no cost on the internet. It's a very fine model, and it has a well-articulated set of 57 countries that interact with whatever policy changes you introduce.
Okay, thank you all. I will yield back.
Thank you. Mr. Paulson's recognized.
Thank you, Mr. Chairman. Let me just start out because several of you have commented or made comments, I guess, regarding how the economic models handle budget deficits and how that debt is a very important factor in determining or understanding, I guess, the model's results. If the committee really wants to get an accurate picture, an accurate understanding of the potential benefits of tax reform, as an accurate as picture as possible, how do you recommend that we address this issue overall? Mr. Barthold?
I think that's probably more of a question for my colleagues on the panel. I mean, our modeling does reflect the fact that increased budget deficits can crowd out private capital formation, but how to address those the policy issues are the members' call.
Okay. Mr. Holtz-Eakin, and then
mechanically, what I would do is isolate the impact of current tax policy versus a reform tax policy. And to do that, first go to the spending side and, at least in a computer, if not in the real world, fix Social Security, fix Medicare, fix Medicaid, so do the big transfer programs on the spending side that are the budget problem, so that over the long term, the debt to GDP ratio is stabilized. It's not exploding. Now you've got a stable spending policy and enact a tax reform and look at the difference between those two scenarios. That's the benefits of tax reform isolated.
Mr. Buckley?
Yeah, I would slightly disagree. We have increasing debt, not just simply because of the spending side. We have one of the lowest tax burdens of any developed country in the world. Our taxes now are like 15% of GDP, our federal taxes, which are really very low historically. It's hard to run a government with a large defense budget and other issues like that with a revenue base that low. Unsustained deficits do affect, I believe, long-term economic growth, and they have to be handled. I do think you can't get there only on the spending side. You have to adjust revenues as well.
Yeah, Mr. Beach?
Well, the first thing I would do is avail yourself of the good work that the CBO and the Congressional Research Service has done in illustrating how crowding out works. Crowding out is kind of a ham-fisted approach to understanding the deficit, because ultimately it's the composition of the deficit, the drivers of the deficit, that you really need to understand best. Many of you probably sit on the subcommittee dealing with health care, and of course health care is driving so much of this deficit. Ask for analysis that decomposes the drivers of the deficit, and then as we reform those drivers, you will see that that has a positive effect on the economy through prices and through competition and through the better allocation of resources, particularly capital resources. And in our modeling, and I'd be happy to share this with you, we have done that kind of work, gone in, looked at the compositional things, reformed those, and then from the spending side, absent of tax change, we see greater efficiencies in the economy just because resources are better used.
Yeah, and I think it's one thing that's very interesting is I've talked to several corporations, and this has not been in testimony here, but we've asked them, how do you use your own projections for your own company and allocation of capital, and a good number of them use dynamic scoring or macroeconomic policy as well themselves as they look forward. And let me just ask this, Mr. Beach, I'll just start with you, but when choosing between different tax reform options, because we've kind of laid into this a little bit, but which types of policies are going to be the most effective or the most likely to produce the dynamic long-term growth that everyone's sort of looking for or hungering for or wanting right now? Are they the policies that kind of give the one-time benefit to kind of give a jump start, or is it more of the policies that provide the long-term sustainable low tax rate payers, rates for taxpayers for the long term?
Well, as fiduciaries of the revenues of the fiscal situation of the United States, you're going to want to look at the long term, and that also is the right answer for the economy as well. So keeping tax rates low relative to other countries, making sure that you're raising enough revenue for your needed services of government, that's the basic thing. Make sure there are as little as possible expenditures, subsidies going through the tax code. That's better done on the spending side. And then that just releases the private sector to lead the economy to higher levels of growth.
Thank you, Mr. Chair. I yield back.
Thank you. Mr. Stark is recognized.
Thank you, Mr. Chairman, for holding this hearing, and thank the witnesses for their patience. We will hear from our colleagues across the aisle that cutting taxes and cutting spending and shrinking the role of government will lead to growth. And I guess that leads to the conclusion that our economy would be better off if we eliminated all regulation and the safety nets and the military and sort of end up looking like Somalia. But assuming that we won't go that far, I wonder, Mr. Buckley, if you could tell me, and I'm somewhat confused by this issue of dynamic analysis and static analysis, if the Republicans were successful in following their plan to eliminate Social Security and eliminate Medicare, what would be the difference if you scored that dynamically or statically?
Well, if you eliminate those programs, you would see large nominal reductions in spending.
Nominal?
Nominal. I would guess the dislocations would be so severe that you would see real economic effects that would be negative. I mean, Medicare is a large part of the healthcare sector in the economy. Social Security is the primary income support for the elderly. Eliminating those two things, which I am fairly confident nobody's talking about.
Oh, yes, they are.
Well, let me put it this way. I would hope no one's talking about would have very serious consequences, kind of put the economy in the safety net back to pre-depression times where things were not as good as they are today.
And it wouldn't make any difference whether you scored that dynamically or statically, we'd still be in deep trouble?
You know, I think, and this is where I don't think the models are very good, they would probably treat that as positive because it removes these distortions from the economy. It creates, you know, really serious economic consequences. I mean, homelessness and hunger are pretty, you know, pretty stark economic incentives. So I'm not so certain if you follow some of these theories, you don't get a positive impact here. And that's why I think so many of these theories are just kind of at their base wrong, and they have not proved to be very accurate. I mean, that's kind of the two things I would say.
Thank you very much. Yield back, Mr. Chairman.
All right, Mr. Marchin's recognized.
Thank you, Mr. Chairman. So far, we have heard from you how macroeconomic models have seen some limited use by the Joint Committee on Taxation, CBO. I'm interested in hearing from you about the extent to which other federal government agencies or even other governments such as the states have used dynamic models to evaluate policy options. Mr. Holtz-Eakin and Mr. Beach, how have they overcome some of the concerns that we have heard about today about dynamic scoring?
Well, I know from personal experience that the U.S. Treasury and the White House Council of Economic Advisors have at times used these kinds of modeling efforts to understand the impacts of policies and ultimately the budgetary impacts. Some of those are in the public domain, and you could look at them. When I was at Syracuse University, I was on the Tax Study Commission for the state of New York, and I was on the Ways and Means Advisory Board for revenue forecasting purposes, and we regularly used models of this sort, which at the state level included a fairly serious scrub of cross-state influences. Could New York State influence what was then largely the outbound exodus of businesses, slow it down? And also these tough issues on capital gains and bonuses, because an enormous part of the New York State revenue was driven by the taxation of Wall Street income. So I think there's a wealth of experience. I couldn't pretend to summarize all the other states, but this is not new territory. There are places that have undertaken to do this both for purposes of accuracy and because their revenue streams sort of demand that they understand it better.
Mr. Beach.
Yes, it's the case that macroeconomic models now play a prominent role in many of the federal agencies as a matter of their routine work. For example, the Energy Department, through the Energy Information Agency, on a quarterly basis runs the Global Insight macroeconomic model, which is the big one. That's the one Heritage uses. It's the one most of the Fortune 500 companies use to develop their quarterly forecast of energy use in this country, and also it's important for the budgeting of the Energy Department and for a lot of the programs that you run through the tax code. The Treasury does that. Doug's mentioned it. I also mentioned that CBO under Doug Holtz-Eakin has vastly increased the number of models which were used. They use 8, 9 models right now, and that's wonderful. The Agricultural Department is famous for its use of macro modeling and has been using those models now for almost 30 years to look at ag programs at the local level. I wrote an article not too long ago in which I called every state in the country to find out what their modeling practices were, and found 11 states, the big ones, California, New York, and others, using macroeconomic models to advise the legislature on spending programs and on tax policy changes, and in the case of about half of those states, required when doing a revenue estimate. I was chief economist for the Sprint Corporation, and I'd like to echo just to say we used macroeconomic models all the time to look at the various ways in which public policy would affect our company, and we were a large enough company that sometimes we could actually affect the outcomes for certain parts of the economy. So it's in widespread use. I tell you, I'll say this in just a second or two. I've been working for getting dynamic modeling up here at the federal level for a long time, and you folks are moving way closer to the goal than you may even sense. Since it is now in such widespread use, we need to get the Joint Committee actively engaged in it to the extent that these other agencies are as well.
Okay, I have one more question for Mr. Bartold. Are there studies that the Joint Committee on Taxation have on hand that show what effect a consumption tax versus an income tax would have on the gross domestic product?
In the mid-1990s, we started doing some macroeconomic analysis and studying how to incorporate our detailed conventional modeling, the results of that I described, into larger macroeconomic models. And the first part of that was to look at broad tax reform of replacing income taxes with consumption taxes. So one place to look is on our website. There's the result of a symposium that we held with with a number of outside modelers who looked precisely at replacing income tax with a consumption tax. But more generally, there are a large number of academics who have published work on that subject.
All right, thank you. Mr. Berg is recognized.
Thank you, Mr. Chairman. I really enjoyed this hearing, and in North Dakota we have dynamic analysis, but we call it something different in our tax policy. We call it common sense. We've lowered our income tax, our corporate income tax, and lowered our property tax this last year. Some of those, it's the third time we've lowered them in the last 10 years. We've seen the exact reality of that. We have a little over a 3% unemployment rate. We have a substantial amount of our state's budget in cash. We're short on workers. We have a lot of jobs that are unfilled. When I was back home on Sunday, there were 8 pages in our local newspaper of employers looking for employees. And so, again, I think when we talk about the dynamic analysis, the more information that we can have, I mean, just the better decisions that we'll make. So as I was sitting here, I was thinking, looking back, and, you know, maybe this is for the joint tax, Mr. Barthold, were there some periods in the last 20 years that we just looked at it, tax policy, totally statically, and even though we knew it would have different effects, we didn't put that into the scoring? Is there things we can look at, again, in the past that says if we'd used dynamic modeling, we'd have been much more accurate than we were? Are there any examples that stand out?
Well, let me try and answer that in a slightly different direction, Mr. Berg, and I hope this is responsive. I mean, we reevaluate estimates and our models all the time in the course of upgrading to try and improve the information that we provide to the members. And so as the models are empirically based, outcomes from the 1990s we use as information for how we analyze things now. Now, recognizing that the 1990s are a different time than they are now, but in terms of looking at behavioral response by taxpayers, looking at shifting of investments across sectors and responsiveness by businesses, that's important data for us. As to if you're asking, are there important big estimates that we got wrong? I'm sure there are, but I'd like to think about them and maybe respond at another time, because I don't want to admit to any offhand in the public hearing, if that's fair.
No, that's very fair. In fact, we'll maybe follow up on that in writing or something.
I'd be happy to, Mr. Berg.
Please.
Briefly, I think there are some lessons, and I want to, first of all, emphasize that there's never been static analysis, not at the Joint Committee, not at CBO. The question is whether you take macro growth effects into account or not. There's all sorts of behavioral responses that are modeled. In 2003, when I was at CBO, we did an analysis of the President's budget proposals, a comprehensive, macroeconomic impact, and that included the 2003 tax cuts, the JEGTRA that came up earlier, and it also included the Medicare Modernization Act, $400 billion of subsidized consumption. And when we did the analysis, what we saw was overall modest impacts of both those things. My conclusion was that if you undertake a radical policy of subsidizing consumption, it offsets the beneficial growth effects of good tax policy, and that's the lesson. Everyone else's conclusion was I did the analysis wrong. The point of this is that we would have been wrong if we just looked at the tax cuts in isolation, because other policy negated the impact. And that happens a lot with the Joint Committee. There's a lot going on out there. It's not just macroeconomic uncertainty and other countries, and there's also other policies that go on that impact ultimately receipts, and getting it wrong isn't really the metric of whether the analysis is done right. There's a lot going on that makes these estimates uncertain.
Thank you. Kind of as long as you're all here, one last question I had is on the capital gains tax. It seems like that's getting a lot of press today, and that at 15%. And just quickly, will increasing that capital gains tax, and again, it's on capital that's already, in my opinion, been taxed once. I mean, is there any model that would show that would encourage growth if that number goes up?
Well, Mr. Berg, I think we touched upon this a little bit before. As you know, under the baseline, the maximum rate on capital gains will increase to 20% after 2012. That's already accounted for in terms of baseline receipts. Your question about growth is what's the overall effect on taxing the return to saving and the increased rate on capital gains, changes in tax rate on dividends, the ordinary tax rates on interest income all go into our modeling when we do macro analysis of what will be the effect on the macro economy.
I'll yield back, Mr. Chairman.
Mr. Pascrell is recognized.
Thank you, Mr. Chairman. Thank you to our distinguished panelists. I want you to know I'm very, very hesitant to listen to people who are part of waltzing us through the last 10 years on economic issues. More Kondraki, certainly no liberal by any extent, said in discussing the tax cuts in February 2003, after the tax cut in 2001, that this is a wild ride Mr. Bush has set in motion. When it's over, we'll know a lot about economics. We'll either be a lot richer as a country or in disastrous shape. The credit or blame will belong to the president. Now, that's what he said 2003, followed by what Mr. Tom DeLay said. The jobs and growth package will not only grow the national economy, whatever models we're talking about, Mr. Chairman, but through that growth, it will help us support and fund the war on terror and other priorities for years to come. The American people understand that the relationship between the war on terror and economic recovery, et cetera, et cetera. And here we are. Now, in the last 18 months, we have seen the addition of about 2.2, 2.4 million private jobs that have been added to the economy. Yet when we go back over the 8 years, and this is not pointing blame because both parties, neither party is privy to virtue on the subject of where we are economically. So please know where I'm coming from. Seems to me we need a more eclectic view when we talk about models, that no one model suits this, particularly because of what you said, Mr. Aiken. There are other factors involved. You cannot just cut taxes and think that jobs are going to be created. That certainly did not happen in the 2001 and 2003 tax cut until 2005, when we had a little bit more of private sector jobs. There are a lot of factors involved. So people who say all we need to do is cut taxes, or all we need to do is cut social programs and we will have nirvana, that's certainly no model that we could adhere to at this particular point. I don't think anybody in the panel would support that. So these are a lot more complex than we think, and you folks have been pointing that out very nicely. I have a question for you, Mr. Aiken, and then I'd like to turn to Mr. Buckley on the same question. in your opinion, how does a statutory rate influence, because we've been talking a lot about this, influence a company's decision to create jobs versus an effective tax rate?
Well, certainly, companies are going to operate on effective marginal tax rates at the margin. I mean, they're going to look at the overall consequences of the tax code for their net gain from adding a worker. I mean, that's the key. Statutory rate will be embedded in there, but it might not summarize it entirely.
Would they think of other things besides the tax rate that would go into their decision in making or determining how they would grow, how they would hire people, how they would not hire people?
Certainly. I mean, as this committee is well aware, the tax code is an exceedingly complex animal with statutory rates, all sorts of deviations from the base, special
Beach?
credits, deductions, depreciation, the whole thing.
Thank you. Mr. Beach?
Yes, they would. The marginal tax rate is one of a spectrum of issues which go into determining the hurdle rate. Every chief financial officer has a hurdle rate in place in their mind. The committee does as well for making an investment. So you have a lot of things that go into that. I will point out that the marginal tax rate, the effective marginal tax rate, is one of the major ones because it varies, it goes up and down, and it is very large. So doing that is important.
Mr. Buckley? Thank you.
I believe it is the effective corporate tax rate that is very important. Our statutory rates are relatively high compared to other countries.
Right.
Our effective tax rates are not because we provide more generous depreciation benefits.
It's got to be part of the discussion.
That is correct. And that's one of the real questions on tax reform. If you do eliminate accelerated depreciation, you do kind of shift the tax burden onto those sectors that rely on that for their major incentive.
That's absolutely true.
All right, Mr. Reed is recognized.
Is that it?
Time has expired, yes. Mr. Reed.
Thank you, Mr. Chairman. I've enjoyed the testimony today, and it's very enlightening, trying to get a understanding, not being familiar with the world that you live in macroeconomic forecasting. From a historical point of view, in judging it from forecast and then as a result of actual numbers that were produced, is there any one model that stands out as one that's been very more accurate than other ones? If anyone could care to, you got a slew of them here in your testimony as different models. Is there one that stands out amongst you as scholars in this area as well?
Let me just take a quick stab at that because the field of models that are commercially provided is a good field to look at. After all, the Fortune 500 companies are kind of picky. They want to make sure that the models that they pick are the ones that are most accurate and have been over the course of time. And without doing an advertisement for any company, I very much like the Global Insight model. It's the combination of all of the old models put back together into one. It is the one that's sitting out there in almost everybody's portfolio of models. And then I must say, then you must go on to develop the models which are best suited for your companies. You need a standard off-the-shelf one, and that's why the MEG model was such a breakthrough for the Joint Committee on Taxation, because it is a great model. John Diamond's overlapping generations model that you've heard about today, you haven't heard John's name, but it's in widespread use throughout this town, and it is getting a lot of attention and a lot of auditing. So that's another one that's rising to the top of the pond as one of the best models. It isn't rocket science to pick these models. There's only a few that are really out there that are any good.
Okay. Mr. Barthold, anything you want to add on that from your opinion?
Well, I just wanted to make one point is we don't, the Joint Committee staff does not make macroeconomic forecasts per se. I mean, we do our modeling to provide information to the members about possible outcomes from the policies that they're exploring. And I wouldn't really be in a good position to endorse private sector enterprises.
But just one other thing, Mr. Reed, I forgot to mention this. The macroeconomic advisors model out of St. Louis is also an extraordinarily good model, and it was that model that was the basis for the MEG model. So you already have a well-respected commercial model that's in. It's not identical to the MEG by any means, but it was kind of the architecture that we used.
It's a good source. Okay. And then other countries that are dealing with these issues and trying to forecast out their tax policy implications. Is there any one country that we could look to in our office as kind of a benchmark to identify and maybe learn something from as to what they do differently than what we do?
There's good science being done by the OECD. More and more, you can go down the block to the World Bank, and they are making significant advances in here. A lot of countries have very poor practices, actually, with respect to modeling, and so there aren't a lot that you can look to. The Germans have done a decent job, but I would look rather to the international organizations and to practices of the states that we've mentioned here today.
That we talked about earlier. All right. Thank you, Mr. Chairman. I don't have anything further.
Thank you. Dr. Bustani is recognized.
Thank you, Mr. Chairman. I would like to explore the limitations of models using a specific example. Over the past 3 years and now in the President's current proposal, he has repeal of certain expensing measures for oil and gas companies that would hit predominantly independent companies, the smaller companies, not the integrated large Exxon Mobils or Chevrons and those types of companies. The most prominent of these is the repeal of the intangible drilling cost. And again, these are measures in a capital-intensive endeavor where you can expense, where the return, if you get a return, is on the back end. And in talking to a lot of companies, they're telling me that if these things are repealed, we'll end up seeing a lot less of this type of activity by these companies. Consistently, the scoring of these measures as a package yields about $45 billion in revenue. And I want to question that figure based on the modeling, and here's why. If you reduce independent companies' production of oil and gas, you're going to, I mean, it seems to me you're actually going to lead to a decrease in, well, certainly a decrease in that activity and decrease in revenue emanating from it. And so I guess my question is, how did that $45 billion come into, I mean, how was it derived? Were certain behavioral considerations taken into effect based on interviews or discussion from what would really happen here? And was there a consideration that we now have a delinkage between the price of oil and the price of natural gas in this country, well, globally for that matter, but predominantly in this country because it's more pronounced here than it is globally. And given that natural gas production, 97% of it's done domestically, it's done by small independent companies. I've heard anecdotal information to suggest that a company that might drill 15 wells perhaps would only drill 2 or 1 if these expensing provisions were repealed. So I want to explore some of these aspects and how they fit into the limitations that these models predict. Yeah. Mr. Barthold, if you would start.
Yeah, thank you, Mr. Bustani. I mean, the question that you raise is obviously an important one, particularly to that sector of the economy. The oil and gas industry is a big component of the economy, and that's the main factor in terms of the scale of the estimate that we produced. But as I noted in my testimony, I mean, we assume, we take into account, I shouldn't say we assume, we take into account that if we change the tax treatment of one sector, that there'll be less economic activity in that sector. Now, that economic activity, though, isn't necessarily lost to the economy as a whole. Now, unfortunately for some of, I assume there's some of your constituents that you've talked to, the independent drillers of gas, you know, they would go out and seek their funding from Doug Holtz-Eakin or a John Buckley, and a Doug and a John would look and say, gee, because of this tax change, the returns don't look so good. You know, I don't want to finance your gas venture. They may turn to the film industry, or they may turn to the microprocessor industry and invest their funds there. So the investment isn't necessarily lost to the economy. And our conventional modeling always tries to account for some shifting across sectors. So the model, yes, does recognize there'll be less. We have done work to recognize the point that you made that oil and gas are different. They're different in international trade, and that can be an important factor in terms of displacement of domestic activity for foreign activity, the ability or inability to transport gas across the ocean. I mean, it's growing, but it's much more limited than the oil industry. So all those factors we do try and take into account, sir.
Thank you. Mr. Holtz-Haken, do you want to comment? Or Mr. Beach?
I would add one thing, and that is that even though it is true that investment dollars may flow to another sector and thus benefit that sector, there are sectors of the economy, once you degrade the capital structure, that are very difficult to rebuild. The transmission system, the production system, and the refining systems associated with natural gas and petroleum must be continuously revitalized in order to keep them at their highest level of productivity and return. And so changes in tax policy that you make for an industry must be taken with great care to think about the long-term consequences of that act. For example, in a model of the economy, we would have to treat it that way.
All right. Thank you. Ms. Black is recognized.
Thank you, Mr. Chairman, and thank you, panel, for being here today with this really complicated issue. I want to return to the issue of the corporate taxes and ask if there are any models out there that assume the burden of the corporate tax, where they assume it in the economy. Do they assume it on the company, the shareholder, or the consumer, and does this impact the model's results? And each one of you can address that, please.
Oh, well, Ms. Black, another important question. Most basic answer is we always assume that taxes are borne by individuals. The question you're asking is what's the incidence of the corporate tax, or more generally, what's the incidence of all the taxes that we have on capital? In the case of the corporate tax, is it borne by domestic shareholders? Is it borne by domestic labor? Is it borne by a combination of the two? Economics literature is divided on this. There's been change through time. The ability of capital to flow across borders leads a number of people to conclude that there can be substantial shifting onto labor. There's not uniform consensus on that. Can it affect the corporate tax affects the after-tax rate of return ultimately to investors? That's a factor that goes into our modeling, and our modeling, as I noted, is ultimately about individuals.
Others want to address that? Yeah.
I simply want to concur with what Mr. Bartold just said. I mean, this is how the economics profession handles this. There has been an evolution over time in their perception of who ultimately bears the burden of this tax, with it shifting more and more toward labor as opposed to owners of domestic capital.
And I would say there's a sharp distinction between corporate executives and the economic models as to who bears the incidence of the tax. They feel they believe they and their shareholders believe it, not labor. So there is a difference of opinion here, I think, between the more technical economic analysis, where it's kind of maybe assumed to be borne by different factors, and what I have seen just from the basic reaction of the corporate executives, where they're quite confident it's borne by their shareholders.
Mr. Holt?
I think there's unanimity that corporations respond to the corporate tax. I mean, they will rearrange their financial policies. They will alter their capital investment decisions. They will change the location of expansions. All of that is part of the transmission mechanism by which the tax gets shifted somewhere in the economy. And if they turn out to be less productive and less able to pay high wages, labor ends up bearing that burden. That's the mechanism.
Well, the corporate tax is borne by labor. That's the way we handle it in our model. That's the bearing of the tax. It goes to an individual. The effect of the tax, of course, is widespread. Mm-hmm. So depending upon the corporate strategies that are changed by the change in your tax policy here, you can see wages, standard of living for a lot of people who are affected in the private sector, the revenues of state and local governments. So it permeates throughout the whole economy. There's the effects, and then there's the economically, theoretically driven notion of bearing. So for your deliberations, I would always think about the taxes borne by labor and the taxes borne by capital, and then think about the corporate tax and which of those does it really affect most. And in our view, it mostly affects the amount and the compensation of labor.
Well, it seems ultimately it's going to be borne by individuals as they purchase the product or the service. But that is not really considered in the model. So in the model, the burden really, it is.
Yeah, it is. It definitely comes in. And those, you know, it's just like the discussion we had about eliminating Social Security. If we reduce Social Security or eliminate it in the models that I use, there would be a definite effect in the reduction in transfers to individuals, and so consumption expenditures would fall. You would see a change in relative prices, and we would all have an effect. So nothing happens in isolation inside these models at all.
Thank you. I yield back.
Well, thank you, and I want to thank our witnesses for their testimony and time today. And with that, this hearing is adjourned.
Okay.
There has to be a common sense rule.
Oh, I agree.